right. Here in the studio, we have Rikin Shah, who's joining in. This is putting the spotlight on the Q4 bank earnings. IIFL Securities, in a recent note, said that Q4 was a quarter of modest positive earnings revision, adding that banks with elevated credit deposit ratio lost market share in FY24. Rikin is with us. He's a vice president at IIFL Securities. Rikin, hi, good morning, and thank you for joining us in the studio. It's a pleasure to have you here. I wanted to start with HDFC Bank because it has been the biggest underperformer. But now, recently, in the past couple of days, we've seen some delivery-based buying come back in HDFC Bank. Your thoughts on that and the way forward?
Okay, so thanks foremost for having me on your show. So on HDFC Bank, we have a buy rating from medium-term perspective. If we take a step back and look at what was plaguing the stock, a lot of things have been plumbed in the last couple of quarters, whether it's in terms of communication to the broader investor community or focus on profitability vis-a-vis growth. So from here onwards, the way we think about it is that most of the negative surprises for the stocks should be largely behind us. The way we think about HDFC Bank fundamentally is that the loan growth is going to be slower at 12-13% for next few years because they have to bring down their CD ratio and hence they'll be losing incremental loan market share. Having said that, the margin outcomes will be relatively much better than the other banks, even in the short term before the rate cut cycle starts and even after the rate cut cycle starts. The other piece would be on the OPEX. Along with some other large private banks, they have the lever to pull back on the OPEX. And asset quality is going to normalize similar to other banks for them. So net-net, what we are saying for HDFC Bank is that you are largely going to make a stable kind of ROAs with the key lever of the margin, which will be a better relative outcome vis-a-vis other private banks. And given where the valuations are, an investor who is looking at a large banking franchise from a medium-term perspective, which has potential to gain significant loan and deposit market share over an extended period of time, this makes an interesting stock pick.
Okay, all right. Hi, Rikin. Good morning and good to see you in the studio. Since you spoke about market share on the deposit front as well, how were the past quarters numbers, first of all? And if you could tell us who gained and who lost market share?
Sure. So if you look at, Nigel, the deposit growth, the 4Q is seasonally typically strong across the banks. Yeah. And that is what we saw in the 4Q as well. So for the banking system as a whole, the deposits grew by 6 to 7% QOQ, but the YOY growth was still around 13.5%. But the interesting bit within the deposits is that the large private banks are growing much faster than the system. We are looking at system deposit growth of 17-18%, whereas the PSU banks are growing only at 11%. Now, what we are essentially saying here is that if we look at the last year that has gone by, the PSU banks have lost deposit market share anywhere between 30 to 50 basis points. This is on account of two things. First, we had put out a report a few months ago wherein we had said that the private banks are going deeper into semi-urban and rural India, yes, which is the home turf for PSU banks, and they are bleeding market share there. And second, the PSU banks have been losing the government agency business, which comes in their car and the SA sometimes. So that is why they are losing the market share there.
Okay, so as of now, going by what you said, is bulk of the good news in for the PSU banks, and would you prefer the private banks? Because actually the PSU banks have outperformed in the last 12 to 18 months. Do you think that's going to turn around now?
So the way we are saying is that for the next couple of quarters, there are a couple of cyclical tailwinds which should continue for the PSU banks. What are these tailwinds that I'm talking about? Because of their low LDR, their ability to do much better or stronger loan growth versus deposit growth, relatively better margin outcome, and third, much lower credit cost even versus private banks. So this trends should persist for next 2 to 3 quarters, but post that they should start abating, and that is when in 1 or 2 quarters we would be more positive on the private banks.
Rikin, you track NBFCs as well?
We have a different analyst who looks at it, but we can discuss.
What are your top ideas there from the house?
So the IIFL house, the top picks for us among the larger names are Chola, and among the smaller names we like 5-Star and Shriram.
Yesterday we had a foreign investor here who was talking about how on the lower end, he was largely referring to microfinance and the lower end of the lending segment. He says stress perhaps is likely to rise. That's what he's seeing elsewhere as well. Is that something you guys sort of notice as well? And
absolutely,
are there investment implications because of that?
Absolutely. So if you look at where the pockets where the stress are emanating from, there are 3 largely things, all of them falling within the purview of the unsecured loans. So the first one is your MFI, second is your credit card, and third is unsecured small ticket size personal loans. What we have been noticing and flagging to our investors is that in the last few quarters, the MFI slippages have been steadily moving up for all the players, even for some of the NBFCs which would be considered gold standard. That's either a function of certain natural calamities in certain geographies or certain political movements in certain parts. Now the slippages have started moving up, the credit costs have started moving up, and there is some worry that the MFI borrowers are significantly levered as well. So this is one segment where we are cautious and looking very closely. Of course, within that also we'll have to be more selective which players can do better.
I want to talk about your other top picks in the sector. In the private sector banks, you have HDFC Bank. You also like Axis Bank.
Sure.
Axis had a superb set of numbers, right, in the last quarter. But what are the triggers from here on? And what is the target price, earnings that you're penciling in?
So Axis Bank along with HDFC and IndusInd are the only few banks where we are expecting low to mid-teens earning growth for the next couple of years on CAGR basis. For the rest of the banking sector space, the earnings growth is going to be pretty subdued given the margin decline due to the rate cut cycle and credit cost normalization upward. The reason why we like Axis Bank is, number one, we believe the stock has the cleanest cost to asset improvement story. So they have around 90 crore rupees of city integration expenses that they incur every month. From September onwards, it becomes zero. So that directly flows down into the bottom line. We have seen some of the larger banks pulling back on the OPEX. Axis has that lever as well. So that's the first point. The second point is that we have done a residual repricing analysis, which suggests that even before the rate cut cycle starts, the margin outcomes are going to be better for him vis-a-vis ICICI or Kotak Bank. Okay. And of course, Axis Bank would also be growing slower, but a combination of these factors suggests that the earnings growth is going to be better and the valuations are still inexpensive at the current levels.
Okay, all right. And we have got those top buy recommendations that are up for our viewers on the screen. And from the PSU lot, you like Bob better than SBI, it seems, because SBI, I think the target price is 840, which is where we are almost at. Sure. So tell us about that. The top pick from the PSU basket is Bob, I believe.
Sure. So it's more of a relative call, Nigel. So what we are saying is that if you look at how the profitability has trended for both these banks, in last couple of years, Bob and SBI are now delivering almost similar ROAs and ROEs, but Bob is still trading at 25-27% discount versus SBI. And even on our forward-looking numbers, the earnings growth, ROA and ROE trajectory is pretty similar for both the banks. Given our view that the PSU cycle tailwind will last probably only for next couple of quarters, this is more of a relative call where we are saying that because it's more inexpensive and cheaper, we prefer Bob over SBI.
Okay. Rikin, one last point. Broadly, and there was an article yesterday as well, I think Tamal put that piece out saying, is this the lowest we'll see in terms of slippages and stuff, right? I mean, this is a long-standing thing that maybe this is the best environment and it's only going to get incrementally worse, maybe not that worse. Does that have any implications at all in terms of how you think about, investors think about sector? Because, I mean, you don't have to buy a bank.
Sure.
As a banking analyst, of course, I mean, you would like something, you don't like something. As an investor, you can avoid the
Sure.
space. Is that something which you hear?
Okay, so I'll answer it in two parts. The first one is that if you look at the gross slippages, yes, they are very low and benign, but the net slippages have started inching up because the recoveries have started abating from the levels. So of course, there is no doubt, I think the slippages will only move up, but what's in the price? All of us are talking about credit cost normalizing. We have built 20 to 30 basis points of higher credit costs. So that's built into the expectation on the returns. And the problem here is that when the banking sector as a whole delivered the best ROAs and margins, the sector did not get re-rated talking about this is just being cyclical and it will normalize downwards. Now when it's normalizing downward, we can't argue of the sector getting derated.
You can't have it both ways.
The ways.
All right, Rikin, great conversation as always. Thanks very much for your time and thanks for coming by.